Now, one of the most common schemes for defrauding a company out of cash is lapping. Probably it's common because it's fairly straightforward. It's fairly easy to accomplish, especially if the company in question has poor internal controls. So here's our scenario. It starts with a problem. One of our customers decided rather than pay with a check, which creates a better audit trail, they actually sent $15 in the mail. Not a good idea. In fact, the Postal Service, from what I've heard, frowns on that sort of thing. But nonetheless, here comes $15. Now, the employee working in accounts receivable, who also has the ability to open this mail, realizes there's a control that she or he could exploit. Says, well, if someone takes the money and I don't record it, who would be the wiser? And he or she thinks about it a little bit, says, yeah, that's not going to quite work because customer A did send that money in, and if it didn't show up on their account, She says, but at the end of the day, I can worry about that tomorrow. So here's what happens. So here she goes ahead and says, I'm going to go ahead and record the journal entry. Debit to cash, $15. Credit to AR, $15. So what's the good news? The good news is that AR is actually correct, right? That's true. There was a payment received. That customer does not owe us that $15. And if she posted it to customer A's account, they're good. They'll never be the wiser. So that fixed one problem, but it has created another. We're now going to show a $15 discrepancy on our general ledger for cash that's not going to show up on the bank statement. Likely would get caught in a bank reconciliation, or at least you hope it would. Meanwhile, that $15 in cash ends up in the, as you can see, quite empty pockets of our gentleman or lady there. $15 in the pocket, but we still have the problem, right? That cash discrepancy. So the employee spends the next 3 days thinking about it. Says, what am I going to do? Eventually they're going to catch on. This is one of the interesting things about a lapping scheme, though. It's really easy to fix. Pay the money back. If he or she then 2 days later took $15 out of their own pocket, added it to that day's deposit, and sent it to the bank, it's done. It's taken care of. The only possible discrepancy that could ever be noted was a 2-day gap between the posting and the deposit, but for an amount as small as $15, I doubt very much anyone would ever notice. But he or she didn't do that. She still got the $15 and says, all right, what am I going to do? So on May 5th, in comes a check from customer B. Okay, so here's what happens. She says, or he says, I'm not going to record that. So customer B, there's no journal entry. All right. And then the other side, she deposits the $10. So again, it's good news, bad news. The good news is she's made cash almost right. She's now put in $10 of the $15 she stole, so the bank account's only going to show a $5 discrepancy. That's good. The bad news is that AR is now out of line by that $10. All he's really been able to do is move the error from the cash account to the receivables account. Worse, customer B's statement now would also be out of line by $10. So we have to get this fixed before customer B receives a monthly statement, or the jig might be up. But our poor hapless employee here is still more concerned about the bank reconciliation. So on May 6th, in comes a check for $5 from customer C. He or she says, that's awesome. That's exactly the amount I needed. No journal entry, and then the $5 goes to the bank. So the good news here, the cash is square. She originally debited cash for $15. There is now $15 that's been deposited in the bank. So as far as the general ledger and the bank are concerned, they're going to match. The flaw now is in AR. AR is now going to be overstated by $15 because these customers paid their bills. They should have received those credits against their account, and they haven't. So if either one of them now receives a statement, they may notice that $10 or $5 error. Or if we do any other kind of reconciliation of receivables, we might find it that way. But let's say the client already we know doesn't have the best internal control if they're receiving cash and there's this employee that was able to take advantage of it. So let's go all the way to the end of the year. It's now the audit. What can the auditor do to find this? Well, the only realistic way without doing a more in-depth examination would be to look at the dates. Compare the dollar amounts and the dates on the deposit slips with the accounts receivable credits. In this case, the AR credit hits on May 2nd, but the deposits don't hit until May 5th or 6th. What's common with a lapping scheme, because you're constantly using the subsequent day's receipts to cover the prior day's thefts, this pattern tends to continue. You'd see this behavior of every day there's 1 or 2 deposits where there's a day or 2-day or 3-day lag. And that's not ironclad evidence, but at least it raises a red flag that the auditor would want to pursue.